as you start to implement infinite banking in your life, what you'll find is you're not saving. Again, we started this off saying not finding more money. What you're doing is you're optimizing your cash flow. You're
Yeah.
freeing up that interest that you had before. And by freeing up cash flow, then you can go use that on the Starbucks coffee. Rather than go out and find the money for Starbucks and find the money for other subscriptions, let's just start optimizing your cash flow today.
Jeremy, too many people are sold into the infinite banking process without a clear plan or how to fund it. It leads to stress, second guessing, or policies that underperform. This episode fixes that. We're going to strip away the confusion, show that the policy funding is not about pressure, but rather alignment. Whether you're self employed, a high earner, or financially disciplined but cautious, you'll walk away with a clear roadmap for funding your policy in a way that supports your goals, your budget, and your long term legacy. Jeremy, why don't you tell our listeners what they're going to learn in today's episode?
Yeah, so this episode is really a blueprint for sustainable, scalable wealth using the infinite banking concept. So today we're going to talk about where to find the funds to start your policy without creating any financial strain. Why infinite banking is a both and asset that grows while giving you essential access to your capital from day one. How to determine kind of your funding floor as well as your ceiling, and how not to overcommit or allow your policy to even underperform. How to create a policy that supports your cash flow today, as well as your legacy tomorrow, and the mindset shift that really
Mm.
goes into the capital allocation, shifting yourself from cost to the allocation and long-term wealth building. Again, think of that long-term range. So I'm excited to get into it today, Jason. As we, one of the biggest questions that we always get out there is, where am I supposed to find the money to start this process? Can you tell us, usually how you answer that question, how you people really help others find the answer to their own questions?
And that's it, Jeremy. It is not about when you're looking at the infinite banking process, it is a process. It is a new skill that takes some training, some testing, and some teaching so you even master it further. And so I loved your lead in. I heard you say, and what we're going to learn today, right? We're going to learn how to think long range. And when we come into these meetings where we're having a strategy call with someone, the first thing is having them financially weigh in, because what we're looking for, Jeremy, and I'm going to have you speak about this a little bit, is we're looking for, are there holes perhaps in your financial system, like leaks in your bucket? Or perhaps you make plenty of money. In most cases, the people I talk about haven't nailed, especially the people we talk to, they have it nailed down. They know how to earn money, right? They know how to go and be creators, be builders that we always talk about. But when they're coming into a call, they might come in with the misconception that this is an investment or this is just another place to put money, another bucket to put their money in. So, what we're looking for is we want to really know where they're at. We really want to know what their debts are, what their expenses are, what their assets and their cash flow is, what their discretionary income is. So, the first thing is really helping someone understand exactly where they are today.
Yeah, no, I love that. Absolutely. We don't want people to go out and look for new money, right? We're just really trying to optimize what your habits already are today. A lot of folks don't realize they typically already have the funds to start. And then as we use infinite banking to really free up their system, we're actually optimizing their cash flow over time. So a couple examples of where is it that people are putting their money, that it
Mm.
may be busy, but it's not necessarily productive, right? So a couple of these examples, an overfunded emergency savings account. We always typically start with using IBC as an emergency savings. I'll say it before in previous episodes. I started this because of COVID, and I saw that a lot of folks didn't have a place for emergency savings, right? So the government did what? They printed a bunch of stimulus checks. We're not saying to replace your entire emergency savings with this. What we're saying is typically people have an overfunded emergency savings, or if you don't have emergency savings at all, this is actually a good place to start. But when you're using money that is safe, but not necessarily working for you, infinite banking and the way that we redirect those funds into a bank account that you control, becoming your own banker, you're actually getting an asset as well. And that allows you to earn uninterrupted compound growth. What we're not doing here, we're not eliminating safety. We're actually just upgrading it. So that's the first place I
Mm.
would look at as an overfunded emergency savings and redirecting some of that cash into a policy that's as truly as an asset that kind of grows with you over time. Again, we're just upgrading your savings here.
And Jeremy, love that. And most people come in and tell me things like, "Hey, my spouse is conservative." And it always makes me chuckle, right? Well, what's more conservative than large mutually owned dividend paying companies that have been profitable for well over 100 consecutive years? Something that started back when society was really about protecting each other, right? Providing for families and creating. And this was built initially to do those things, to give you that peace of mind, to give you the control, to give you the guarantee. So I love that you're talking about you start. I think it starts rather than jumping into each bucket. What about the question, Jeremy, of where is your money going right now and who is in control of that scenario, right? And this will lead into the next thing we're going to talk about because think of and what I mean by that, if you're putting it into a bank account, that's great. Maybe you even have it in a high yield account, right? We talk to a lot of those folks where they're getting 3.8. If you're driving and you have a high yield, feel good about that because you've already understood, well, hey, my money I either pay interest, I earn interest, or I pay cash and give up the opportunity. You already understand that you finance everything. So if it's in a high yield like a 3.8, 3.85, 4.25, I've seen them come down recently. I have a lot of these calls. I talk to a lot of you folks but now you say, what if you use that money? Do I interrupt the compounding? And that's just one scenario. Like in a bank, like Jeremy's talking about, the first one, are you overfunding your rainy day fund? Where's a better place, an optimized place to keep that money? Wouldn't it be somewhere where that money continues growing, where you can use that same money with instant access, where it's protected from liens and judgment? These are some of the fun things that infinite banking brings, where it gives you a guaranteed legacy. But the question starts with where is your money going that you're paying yourself first, Jeremy? And how much are you paying yourself?
Yeah, that's a fantastic question. And it is a really good segue into the next section as well, because what you're really talking about is opportunity cost, right? You're talking about the opportunity cost of using your capital and having the ability to have a both and asset, really. And when you have Daddy Dave out there telling folks to aggressively pay down their 3% mortgage or their 4% car note, they think that's a really smart thing to do. But they're losing the ability to use that capital elsewhere, right? That's the opportunity cost of this. And when you're able to take the equity and you're converting that cash into equity in your home, you actually just tied it up. And the only way to access that is through a HELOC or selling the asset, right? Because really you just became house rich, but cash poor. But what if
Yes.
you could redirect that into your own banking system?
And Jeremy, that is the point. Like, don't I want people to hear what Jeremy's saying because this is a simple concept. And it's as simple as changing one thing. Where does your money go first? Are you paying yourself first? So, like Jeremy said, the velocity of money is a real thing, right? Like with a HELOC, you can use strategies where you're using the velocity of money to reduce the interest by just paying it on a different schedule. But what is happening? Who's in control? That was the question I was asking. Who's in control of the HELOC? Is it you? I mean, you are controlling what's happening, but you don't own it. The bank still does. So the bank's in control. And you're also, it's about cash flow. So if it's all going into the HELOC, yes, it's accessible, but is it doing anything else for you? I think that's one of the big things, Jeremy, when we're talking about, first, we're really talking about where are there leaks in the bucket? Where do we find a way to pay ourselves first? And so far, we've talked about overfunded savings and maybe overpaying on something that we just want to do what Daddy Dave says and just don't have any debt, right? Which is an
Mhm.
awesome strategy, but let's think about when we overpay on homes and other things, what the cost is, what we're giving up, because there's always a trade-off with every scenario.
Yeah, well, what I really like about this is they can still aggressively pay down debt, but where are they redirecting those funds first, right? So if you take that capital, you put it into your own banking system through your policy loans, you're actually able to still aggressively pay down that debt, but you do it on your terms. while at the same time creating an asset with a sizable death benefit for added protection. Because that's what this is about, right? People typically aggressively pay down debt because they want protection. They want the peace of mind. But what better peace of mind out there than to have an asset that you control that's completely within your bounds and limits, and that also has a death benefit out there that takes care of your family at the same time.
Incredible. And then think about this too. Like if you are, I hear this in almost every call when I ask, like, hey, are you contributing? Are you contributing to a qualified plan, to some kind of retirement plan with your company? And I always get, yes, I'm contributing up to the match, the 4%, 5%, 6% match. And sometimes people are contributing 10%, 12%. I had a guy the other day, Jeremy, 19%. And I was like, whoa, that's amazing that you're caring that much for your future self. Because remember, that's for your future. That money is locked up with it's locked up with stipulations, penalties if you need the money sooner, if you need it, and if you want a loan, well, it also has the different rules and regulations around it. So you're putting that money for your future self. You believe you're getting a match, but the reality is you have a partner. And Jeremy, you know this partner, right? Like you were pretty intimate with this partner in one of your careers where this partner is a good guy. He's pretty easygoing. He doesn't really expect anything from you. You know, you start that new job, you make it to year when you can start contributing to that qualified plan. And then what happens? That partner lets you take that little itty bitty seed, Jeremy, and over a lifetime of trading your time for money and getting that match, he's going to sidle on back in. He's going to put a little bit of elbow in you, be like, Psst, hey, man, I had a great time. Life has been awesome. But hey, yo, Jeremy, I'm going to need my 38.5% now, man. There are no guarantees with that, is my point. So I just want you to think about where you're putting your money. Are you really controlling it? Does it give you access? And what does it mean? Jeremy, define this for people. What does it mean when we defer our taxes till later?
Yeah, that's just effectively choosing to pay taxes on the harvest, on the full wealth, right? We're rather than pay the taxes today, as you do kind of like your income tax or any other tax that we have. Instead, we're deferring it into our future lives, something that's not guaranteed, something that's out of control. We don't know whether or not taxes are going to go up or down. So let me ask this question. What is the value of a dollar you can't spend? When you tie it up in these qualified accounts, you're basically saying, I'm going to choose to use this money in the future at a time that I don't know if taxes are going to be up or down, but I'm going to defer that capital, my future to my future self. So what's the value of a dollar you can't spend? If it's tied up and you chose to work with the government and partner with the IRS, that's the partner, by the way,
Mm.
that Jason was alluding to. But
Uncle
yeah,
Sammy. Uncle Sammy was the partner.
yeah, I don't want to necessarily partner with Uncle Sam all the time, right? Like I like Jason a lot more. He throws better
Ah.
barbecues. And he's not charging me 38% to go to his barbecue, which thank you very much.
Yeah, yeah, you're welcome. You're welcome. And another one is going to be lifestyle creep, right? Parkinson's law. We always
Oh
look
yeah.
like at right as we earn more money, right? What do we tend to do? We tend to spend more money and we find a way because marketing is so powerful and it's always in our face now when we have these little devices. So we find a way, oh, this is only $7 a month, $8 a month, $10 a month. And all of a sudden, we've got 500 to 1500, $1,000 a month in auto payments for things that we don't even use, that we don't even know we have. Because in that moment, it felt good. Like, yeah, I'm gonna get this. I want to sleep better. Let's have someone track my sleep. Or Starbucks, man. I go to Starbucks maybe twice a week when I cycle afterwards just to kind of chill with the guys. And some people are on a regular schedule, man, and they're coming in. I'm like, wow, what a brilliant business. They get all their needs met, they get their fancy name on their cups, they bring in their own personalized cups, but they're spending 10, 12, 15 bucks a day. Add that up for a week, right? Add that up for a month, add that up for a year. That's a lot of financial leakage. I'm not saying don't enjoy your life. I'm just saying really know what your goal is, tie that long-term vision back to today in the present.
Yeah, if you really get clear on your why and why you're building a system like the infinite banking concept, that long-term wealth building doesn't become, can I afford it? It actually becomes your purpose, right? You're actually doing this intentionally. You're doing it with purpose. And these trade-offs that we talk about with the coffees or the screen and the memberships and subscriptions, those become really easy. They're not painful, right? We're still enjoying our life today, but we're building for a strong foundation, a wealth foundation, right? And as you start to implement infinite banking in your life, what you'll find is you're not saving. Again, we started this off saying not finding more money. What you're doing is you're optimizing your cash flow. You're
Yeah.
freeing up that interest that you had before. And by freeing up cash flow, then you can go use that on the Starbucks coffee. Rather than go out and find the money for Starbucks and find the money for all these subscriptions, let's just start optimizing your cash flow today.
Yeah, let's simplify things. We're not asking anyone here to do anything complicated, right? Like I like to say it's simple with Sipple. I'm a pretty simple guy. Like I'm not very technologically savvy. There's a lot of things I don't know how to use, but I do like when you have the infinite banking as your foundation, you know that you're paying yourself first. You can figure out exactly how much that is meaningful for you and is manageable, which we're going to go into, but it really gives us that floor and that ceiling to work for. We want to make sure, because if you believe like Jeremy and I do, the wealthy have more choices. If you believe that, say yes. Like say yes in your car when you're listening to this. If you believe that's true, because we want to give you more choices, not less. We want to give you more control, not less. We want to give you a foundation that's guaranteed, not speculative. So we're just saying, think. Think what's happening, and we will help you identify where the funds are at. And then you decide if you want to move those funds to something that's going to be more optimal or not. We're not telling you what to do. We're just showing you how you can do this, where you can find the funds, because that's the first question.
Yeah, and folks, you're not shifting from protecting what you've built. We're actually empowering you with what you can create. And that goes back to being a builder or a borrower, right? As a builder, you're building for your future. You're building a strong foundation on which you can build your own financial empire. But what you really need to understand that this is not a either or asset, right? You're not choosing to have a payment or choosing for the subscription. You're actually able to, again, optimize your cash flow because infinite banking is a both and asset. And a lot of folks feel like they have to choose between funding infinite banking and investing
Hmm.
elsewhere. But Jason, what would you say to something like that? What is the mindset that comes from that traditional financial advice?
Well, the traditional financial advice is that it is traditional, it's in the box thinking, it is how we've been groomed to give up control, Jeremy. I think about this all the time. I actually sent you an article about this week by someone I really admire that's a builder, right? That is doing pretty amazing things. But I'm always seeing the, hey, keep your money in the market. You're in for the long term. It's for your future. And we know that when you're looking at investors, and you work with a lot of real estate investors, and I do as well, but it's very much, I can do this investment or that investment. I can go do this fix or flip, or I can go invest in this, and then they come talk to us, or I want to do this investment in infinite banking. And we tell them, no, this is an and. This is an and strategy. And we're going to talk and give you an example here in a moment, but this is an and strategy where now you're paying yourself first, it's growing guaranteed, it's protecting your family guaranteed, and you can use the loan against your funds, right? Against your cash value from the insurance company to go invest in the thing. Because now you have guaranteed growth, you have protection, it's an and decision. So every time we use this as our foundation, it's an and versus an or. When you do investments, there's always risk. I do this or this or this. Every single one are 100% risk. You don't know they're going to work out. That's the definition of investment, right?
Yeah, yeah. Investing is money that you can afford to lose. Saving is money you cannot afford to lose. And infinite banking really breaks up that binary thinking, right? Because infinite banking is a both and strategy. You get the safety of compounding growth using whole life, and you also get to maintain control and access to your capital while taking the tax advantages through the policy loans. So I want to give an example of Andrew, right? So Andrew, guy I know from my military lifestyle, my previous, it feels like decades ago, but it wasn't. It was maybe 5, 6 years ago. But so I knew Andrew, really good saving habits. Let's just start that right there. Andrew had really good habits, financial habits, but he felt as though a lot of his capital was kind of lazy. And we discussed that earlier, right? About lazy capital. He had about $75,000 sitting in a high yield savings account. And it was locked up. It was earning, at the time, interest rates were pretty low. So his high yield savings started dropping, and he saw the fluctuations and how that changed kind of on a monthly basis. Nothing was guaranteed, but he wanted to do more with his money, while at the same time, his family was expanding. He
Mm.
has multiple children, and he wanted to create some safety and guarantees and protection for them as well. So he came and asked me, Jeremy, how can I put this money to work? So I built him a properly structured banking policy built around the infinite banking concept. And that gave him immediate liquidity, right? So he had that liquidity within the first 30 days. He also, by building it this way, had uninterrupted compound growth. And he could access all that growth tax-free through policy loans. And it also provided him that protection for his family, right? His growing family, for whom he loves, wanted to be a great father. But check this out. Within about 6 months of funding that policy, one of his buddies, a fix and flipper, was looking for capital to go out for an investment. And so Andrew, guess what? Had access to capital. He didn't have to go to a bank. The other guy didn't have to go to a bank. They were able to work on a mutual agreement where Andrew was the capital investor into this partnership, and the other guy did the work. And within 8 months, they ended up, doing the full rehab. They liquidated that asset, and Andrew got all of his capital back. Well, what did he do with it? He just put it right back into his banking policy to recycle and repeat the process. So
Mm.
when we talk about having a both and asset, it provided him those guarantees, that safety, that protection for both his wealth and for his family, but it has also served as an opportunity fund, the next phase of what we talk about. We want to lay that foundation of protection and then layer on top of it the opportunity for when it arises. So when Andrew was able to recapture and reuse that money, guess what he's doing now? Now he's not just a military officer, he has additional streams of income because he's able to go out and invest into other real estate projects. That one went well. And he's able to go out and reuse that capital into other opportunities.
And think of that gift, what you just talked about. Like everyone listening, you may have heard, depending on where you're at in your life and how you're listening to this and what your frame is, you might be just hearing, oh, wait, this is a way that I can build an opportunity fund and then I can lend out money and I can create an additional income stream. The part that Jeremy mentioned and said a few times was his friend Andrew was expanding the family. And men, the men listening, our jobs, our roles in society are to provide for our family, to protect our family, and to procreate. I always joke around, say, hey, if I do the first two well, Patty might let me do the third. I don't know, but so, but it's about being a creator, a builder. And so what Andrew effectively did, and I know because this happened for me as well, when he knew his family was protected, when he knew that he could go out and build, guess what? That puts you in an abundant place in your mindset where you know that your family is going to be taken care of. And you know that you have guaranteed growth in that opportunity fund. And you know it's not tied to the market and the fluctuations. You're not worrying about the taxable piece of it. It gives you so much peace of mind that it lets you go out and create. It encourages you to create because you've built something solid that lets you do what you're innately wanting to do as a man: provide, protect, and if you're lucky, procreate.
Yeah. So this kind of really now starts getting into, okay, well, how should I fund my policy? And we really like to talk about a base, like a floor, right? And the ceiling, which would be a MEC limit. This is the really honest to goodness, one of the reasons why it's so important to work with a certified infinite banking practitioner. Because if this part of it is designed incorrectly, you lose all your tax benefits.
Wait,
Okay.
you're a certified infinite banking practitioner? When did that happen? I didn't know this. For real? Wait,
Yeah.
you're in a really rare breed, like a Jedi, right? There's only like 310 of those fellas and ladies out there. Is that true?
Yeah, well, I'm speaking to one as well. Yeah, there are about 310 of us that are out there. And, if you don't resonate with either of us, there's a great, resource that we can direct you to where you can find someone else. But this part of it and finding the base and finding the ceiling and designing it really is important. And when most people think about premium, they think of it like a bill, right? Something that's fixed, something that's rigid, something that is stressful. But with infinite banking, we flip the script on that entirely, don't we? Instead of asking, what is the minimum that I can get away with? Instead, we help our members ask, what's the right range for my goals, for my income, for my future opportunities? This gets back
Yes.
into what's meaningful and what's manageable. And that's why we use the concept of floor and ceiling. So the floor, what is the floor, Jeremy? You keep talking about the floor. The floor is your base premium. It's the consistent amount that you commit to funding in your policy. They're on a monthly basis, semi-annually, quarterly, or annually, right? It builds the foundation of your policy. And then on the flip side of it, you have your ceiling. That's your MEC limit. Your MEC is an acronym, Modified Endowment Contract.
Oh, I
And that's
thought it
the
meant maximum efficient contract. That's what I thought it meant. We bring it right up to the MEC limit. But no, back to Jeremy. So real quick on the floor piece, when he's talking about the base, when he's talking about the frame, he's talking about the structure, the whole life portion of things. This is the vehicle we're using, right, from a mutually owned company. So that is your manageable piece. Now Jeremy's going to explain further on we have that floor, we have a ceiling, and then we have a focus because the first thing is think long term. So, Jeremy, back to you in your explanation of that ceiling.
Yeah. So the MEC limit is when the IRS starts getting involved. That's the modified endowment contract. And that if your policy ever turns into a MEC, if it ever turns into a modified endowment contract, all of your gains become taxable, right? So that's the maximum that we put in there. That's why we call it a ceiling.
Fun fact,
Yeah, go
fun
ahead.
fact is that modified endowment contract has the same rules as guess what? A qualified plan. How interesting is that? You know why this happened? Real quick, fun, off in history world. Go look up Tamara, Tamra. 86 and 87, wealthy people were being told to stuff as much money into whole life as possible, even though Ralph Nader said it was bad. And then they stuffed it all in there. And then the IRS said, hey, Uncle Sam came in. He said, hey, what about me? You can't leave me out of this. You can't leave me out of this pie. So now we have a modified endowment contract. And that's why. So he could
Yeah.
have his cut.
Yeah, and you don't have to hit that ceiling every year, right? But if you want to, it's there. And that's really good for a lot of our commission-based professionals or someone who gets bonuses every year or people with tax refunds, right? Folks that have windfalls of money, that ceiling is there to be able to capture that cash flow into your system without going into the taxable events. So how do we do it, right? There's a couple steps. Step one is start with peace of mind, not
Mm,
a maximum contribution. That's
yes.
step one. We always want to start by asking what amount feels totally sustainable, even in a slow season. Think about a realtor as an example, right? There are ebbs and flows in seasons. People typically have some sort of like high season or peak season in volume, whether it's working or commissions or however it's going to be. But we want people to have a confidence in that consistent cash flow. So we start typically with what is peace, like peace of mind, and what is this totally sustainable over time. The next step that we get.
Jeremy's saying, what is your cash flow? Like, how are you receiving money? Like, if you're an employee, maybe it's consistent, persistent, and maybe you get a bonus at the end of the year. If you're, like you said, if you have something that's seasonal, then you might get a big bonus at the end of each quarter or not, right? So you can design it. Remember, the wealthy have more choices monthly, quarterly, semi-annually, annually. Just ask yourself, how do I cash flow? And you can change that year to year if all of a sudden you cash flow differently.
Yeah, and that's usually where we start with kind of the base when we talk about the floor, right? If we know the kind of the predictability, what's sustainable over time, that's how we kind of figure out our floor limit. But then we want to design a policy with optionality too, with growth. And that's when we get up into the PUAs or the paid up additions, as well as getting up to our MEC limit, right? So when we look at the average income or windfalls like bonuses or distributions or tax returns, that's when we look at building in the additional, the PUA rider. And I've heard people talk about it being the nitrous oxide in a race vehicle. They've talked about it being the rocket boosters on a rocket ship. There's so many different analogies that are out there, but really what we're saying is this is giving you the optionality to grow and expand your system, and it provides that early cash value today.
And the flexibility, like the PUAs, when we build something that's going to be meaningful for you to help you hit that long-term focus, to solve your immediate need, because we both believe, Jeremy and I both believe that progress is going to equal happiness. We want you to think and own this as the banker. So know what's going on in this new system that you've created for your family, for your long-term goals, and also know that that's manageable. So, like, say you're 3 years into it, you have a big life change. Well, then you can go all the way down to the base. That's a question I get almost on every single one. What happens? What happens, Jason, when I lose my job in a couple of years? What happens when I get to this age and I don't want to be working this hard? And The answer is really, well, that's why we're building something that's manageable, something that you're already saving today. And we want you to maybe stretch at times. Like I like people who want to stretch up to their ceiling, but I also want to make sure they've done that with some consistency before ever starting their journey because they need to know that I can pay myself first.
Yeah, this is a system again that you get to control, right? You get to decide your range, and that's a you answer. We don't provide that for you. When you ever come to us and you work with us and say, how much should I contribute, right? We'll come back to this process. What is meaningful? As in, what do you want this policy to do? Not just today, but also long range. If you want to build in the safety, the flexibility, the protection, then you want to think long range and build in the opportunity like Andrew did. We build that. But
Yeah.
we want to give you that seasonality, that options to be able to grow and expand your policy over time.
And bumper rails for you. If you do ask me that question, I'm going to ask you what is your gross income? Because I want to know what 10% is. I want to know what 10% of you paying yourself is. And then I'm going to tell you, well, hey, an insurance company, a carrier, one of these mutually owned dividend paying whole life companies, I like to repeat that so you remember that it's not an IUL. Jason and Jeremy did not say IUL ever. But that you have you're not going to bowl a gutter ball with us because we're going to tell you, listen, the insurance companies are only going to let you put in 20 to 25% of what your gross income is on an annual basis. And then you can decide what is that 10% that I'm paying myself first? Is that going to be meaningful and manageable to help me hit my goals? Those are the questions in the prompts that any good infinite banking practitioner will ask you because it's your system. You have to tell us how much you want to contribute to whose system? Your system, not Jeremy's, not Jason's, yours.
Yeah, and we definitely design these with growth and grace in mind, not pressure, right? And I want to give another example of someone I've worked with in the past. She came, her name is Monica. She's 38. She also has children. She also has a side business, right? And she came in, she's talking about, Jeremy, you mentioned the floor, you mentioned the base premium. I want to find something that's affordable for me over time, but I like the flexibility that you talk about with these paid up additions riders. And I want to figure out how to build consistency and confidence while also maintaining momentum. So I sat down with Monica, and it was over, the course of one, two, three phone calls or whatever. And she came and she said, hey, Jeremy, I really, really do like this concept, but I have commitment issues when it comes to big numbers. And
Mm.
I've made commitments in the past that I couldn't keep. And I don't want to start this process and feel guilty if I'm not able to do that. Have you heard that before, Jason?
Oh my goodness, yeah. And I laugh. I start telling people right away, like, hey, this might be a forever conversation. This might you're committing to us right now for your whole life. This isn't like, like United States with 50% of marriages ending. This is something that you're committing to for your whole life. And again, this is why we're saying it has to be meaningful, it has to be manageable. But a question I'd ask people, Jeremy, is, hey, how often in your adult life have you not had a mortgage payment or a car payment? Did you ever hesitate on committing to that because you needed that thing? And I really think that's a psychological, mental thinking thing, Jeremy, that this is actually more important than all those things because guess what? This can pay for all those things and keep the interest in your family and protect the family. But that's not the question, right? It's like, oh, well, I can commit to a 30-year mortgage, but I'm a little afraid of what's going to happen 5 or 6 years of the whole life. So, yes, I hear it all the time.
Yeah. Well, for her, we want to do something that was manageable. So I built one with a very modest base premium. Her policy was actually about $300 a month, is what we were looking at, right? And that fit comfortably for her lifestyle with what she was willing to deposit into her own family system. Again, it's her system. It's what she deemed that was right for her. But we had those flexibility with the paid up additions riders, right? So I want to fast forward 3 years. So she was one of the first people I started working with. She contributed consistently to her policy through that 3 year period, and she added the paid up additions when she could.
Mm,
She took, over those 3 years, two policy loans. One was a covered emergency. Again, we started this off with create a good emergency, a good financial foundation for you, right? The other one was to fund inventory for that small business. She had a side business that she wanted. So she took two policy loans over the course of those 3 years. But guess what? Her cash value still continued to grow despite the policy loans, right? You don't get that in traditional banking. You get that by becoming your own banker, by practicing the infinite banking concept. More importantly, through that 3-year period, she built up the confidence and the clarity to think long range. And for the first time in years, she actually felt in control of her own capital, right? Did that because she had something that was meaningful but also manageable for her. So before we gave you the example of Andrew, who started off big, but think about Monica here, who's starting off also small, something that's meaningful and manageable for her. She didn't have to start big. Instead, she started bold. She didn't start big, she started bold with a plan that she respected and that fit her current lifestyle at that time. And she experienced the very single thing that we talk about most often, right? She had a system that grew with her and her family. Instead of shaming her into action, she actually felt comfortable and took responsibility and ownership while providing for her family and being able to cover these unexpected expenses like the issue with her home, right? While still growing long range, the opportunity with her side business.
I love Monica's story. I love your heart, brother. I can feel that win for her as just as big a win for you when we know that we're empowering someone, right? When we're meeting someone exactly where they're at today, and we're not, we understand that we're helping you hit your long range goal. We're asking you what your goal is 10 years, 20 years, 30 years from now, the legacy you want to leave your kids, your grandkids, your grandkids' kids, right? Like multiple generations. Because a lot of us are interrupting old broken patterns in our families. Most of us are generation one bankers coming into this. So what Jeremy's talking about is let's meet you where you're at today. Let's empower you with something that is meaningful, manageable, and helps you hit that long term focus without the pressure and the stress and the worry. No, just a system, a process, discipline, self control, self awareness, where you're building something and the confidence to be bold, as Jeremy stated.
Yeah, you don't have to choose here between security and opportunity, consistency, or flexibility, right? Again, this is a both and asset. You can have all of these things. You just got to make sure that it's meaningful and manageable. As you're building out and you're having that dialogue with your strategist, make sure that you're answering those two questions. What is meaningful for me? What do I want this policy to do, not just today, but also long range? But what's also manageable for me today and also long range? And this doesn't have to be your only policy, right? We talk about as you optimize your cash flow, as you become your own banker, you're going to find more opportunities. That's when you just start another branch of your bank. There's nothing limiting you to having more than one policy. But for your very first one, I would implore you, start with what's meaningful and manageable. I know that when I started my first policy, right, I was figuring out how the process goes. I knew what was meaningful and manageable for me at that time. And as I figured out how this works, how policy loan structures work, within 6 months, I started my second branch of my bank, right? My wife already has two branches to her bank as well. So as the Sipple family, I know you guys have multiple branches to your bank. That tree has multiple branches, right? Your banking system has multiple branches as well.
Think of the redwoods in California. Think about how their root system keeps those giant trees and the ecosystem and connection. That's where you're building your, or think about your regular bank where you put your money now that they're making 400 to 1300% on every dollar that's deposited there, even if they're paying you in a high yield. They're making a lot more money. And then what do? They turn around and say, hey, you need money. Let me help you finance it. Why would they do that? Because they're going to make a lot of money. So instead, why not make your system meaningful for you? Why not grow it into something that is going to be able to expand as it gets efficient? Because you're going to get to a point, like Jeremy said, where you're going to have to increase your warehouses of wealth, open your additional banking. For me, it was the same thing, Jeremy. The first one was taking back control of all this money that was going to other families in debt, family of Ford, family of Hyundai, and bring that back to the Sipples. Most money I've ever saved in my adult life. And then the second one was protection because I realized I was 5x more protected than Patty. We owed Uncle Sam some money for the business. And I was like, hey, Uncle Sam, I want to make sure that my money is growing guaranteed, protecting my family, and my wife is protected as I am because she's so valuable, right? And it's about that protection, that guarantee. And then you keep expanding when you have new problems to solve because your thinking will keep rethinking. So don't worry about how many do I need, hearing people that have 70 or 28 or 14 or like I have four. I heard Jeremy mention they have at least four, right? Three or four.
We
And
have in our system, so I have four policies myself, my wife has two, and I'll be opening a fifth one later this year.
Awesome. So Jeremy's going to have 7 in his family, right? And he's doing what's meaningful and manageable to him. So it's what is it for you? Just think of that. It's about you. It's your journey. It's not my journey, Jeremy's journey. Don't go compare yourself. Just see where you're at today and can you be better? Can you be more optimal? Can you have less leakage, more guarantees, more long-term growth and protection while you're providing?
Yeah, absolutely. So as we start to, wrap things up again, make sure that your dollars have purpose, okay? Look at where you're funneling your money already. You likely already have the capital to start this process. This is a both and asset, not an either or. It's a both and asset. And when you start building out what is meaningful to you, what is manageable to you, make sure you're having that dialogue with your family as well, because you might find that that protection piece actually plays a bigger role in your life than you actually realize. So, Jason, as we wrap things up, do you have any closing remarks?
This is a great episode. I love being in this space with you, my brother, and all the listeners listening to us. Remember, if you don't know something, it's you don't know it yet. So give yourself permission. Be kinder to yourself. That would be my closing remark. Be kinder to yourself. Know that you've got this. Whatever you want to create in the future is available. And if you need help, we're here to educate and empower you to reach your goals.
Yeah. And even if you haven't started your infinite banking journey, we want to remind you, you're already in banking.
You're just not the bank yet.
All right. Until next time, take care.
Take care. Thanks for joining us on WealthWise Banking. If today's episode inspired you, please subscribe, leave a review, and give us a like. It's a simple way to help others discover these empowering strategies and join our community. Together, we're building a network of people who believe financial freedom is within everyone's reach. Remember, financial independence is about making every dollar work for you, one step at a time. Until next time, stay inspired, stay in control, and keep building your legacy the wise way.